Okay, thank you. So still me, and you cannot get away with me. And but I'll be done quickly so that you can enjoy your things. And yeah, so this is again a very international team, and actually all the other team members are from China. And this is actually something we kind of worked on, started to work on a while ago. So some of the results may be a little bit stale. I just have to give you a heads up, but I nevertheless think there is something interesting there, and would love to get your thoughts on this. All right, so what the research question that we started thinking about is that we know that cryptocurrencies are traded a lot, and there are a lot of studies on the secondary market trading of cryptocurrencies, and but we just want to ask a different question. But I think there's just not much studies on the primary market, right? The listing of those cryptocurrencies on the exchanges in the first place. So we want to just have a better understanding. Then we started the project. We just want to have a better understanding about the listing stuff, about all the listing stuff about cryptocurrencies. So then we just chat about it, and we think about what are the interesting questions we answer. And we are listing some questions here, and I don't think these are exhaustive, and feel free to feed us any other questions, but this is how we started off. We want to understand what are the performance associated with the cryptocurrency listings. Well, first of all, this is probably what you already know, but we just want to give a more formal account for a formal empirical evidence for that. And how do these performance vary across major cryptocurrency exchanges? And how do cryptocurrency exchanges select cryptocurrencies to list, right? So do they select cryptocurrencies with better fundamentals? And also, are there any conflict of interest in the listing decisions of cryptocurrency exchanges? Especially, we know that a lot of cryptocurrency exchanges, they have their own VC arms, right? If you have your VC arm, you have invested some coins, and certainly you have incentive to have those coins to be listed, right? So, but now you also, if you run an exchange, does that actually cause some agency frictions, cause some conflict of interest? And also, just like for all these, right? What does the regulation come into play if at all? Okay, so these are the questions we start off with, and we want to give some answers, shed some light on that. I think there's more that we can do in this aspect, but I'm just show you what we have now. So the overall roadmap for the talk is that we are going to, basically the paper is two parts. First, we just do a very simple case study. We're going to compare the two biggest exchanges, Binance and Coinbase. We choose them because they are the two biggest, and also arguably Coinbase is a public listed company in the US, so they presumably are under more regulatory scrutiny. And Binance, until today, I would say probably, right? So they kind of mainly operate outside of the US, and the regulatory exposure for Binance is arguably weaker than Coinbase. And like CZ famously went to prison and for 4 months and for whatever alleged anything. Anyway, so yeah, so that's the case study that we are going to do. And after the case study, then we are going to also have a more full-fledged regression analysis. And we're going to have about 80 different cryptocurrency exchanges. And we will develop a very simple regulatory exposure index for these exchanges. And we are going to see how does that index kind of are associated with the listing performance of the coins on those exchanges. Now, that's the two parts that we're going to study. So let's go to the first case study first. So as I mentioned, this is something that we started working on for a long time. We didn't update the data, so this is maybe something, if you want to criticize the paper, then the data is until the end of 2021, so that's a little bit old. So the sample, how we select the data is we look at all the listings that goes on in these two exchanges until then. And the initial sample on Coinbase was 135, and on Binance was 366. And then we need to drop some samples. So first we drop stable coins. And second, we drop those wrapped coins, right? And then we drop forks, and we also drop those leveraged tokens. And after that, and we also just drop Bitcoin, Ethereum, and Litecoin, which just were listed before 2017. These are the major ones. Any exchange, you should probably list them. And then also we drop any coins, there's a very small sample of them. The trade data is not available when listed on Coinbase. So by the end, we have a sample for Coinbase about 112 coin listings, and for Binance, we have 300 coin listings. And then we're going to compare them just for the first part of our study. So just some summary statistics. For these large exchanges, right? So most of the coins has already been traded on other exchanges before they get listed. So actually, like the mean is about 600 days. So it's more than almost like 2 years, almost 2 years, more than 1 year, a little bit shy of 2 years. So the coins have been traded a little bit before they actually get listed onto these large exchanges. The market cap is about, on average, about 1 million. This is on Coinbase, and we can see that on these columns that we can see that these are the cumulative returns from day one until, for example, this is the first 4 days. This is first 5 days. This is the first 10 days, the first 30 days. Right? We can see the listing performance are all pretty positive. Right? And we also look at the listing performances before the coin's performance before the listing, right? But these data are available from other exchanges because that's before they got listed onto Coinbase. And also we can do the summary statistics also show us very similar pattern on Binance. Binance is more aggressive in terms of their listings, right? So they're usually the number of days before being traded is less than 1 year. And the market cap is much smaller, and this is just consistent with Binance having a more aggressive trading, listing decisions. The initial listing performance still also significantly positive. So if we try to, so the first result that we show, I mean, this is not too surprising, I think, for most of you, but I think just nice to have them formally presented. And we look at the listing performance across different periods on the Binance and on the Coinbase sample. And we found that, well, like first of all, as they are both significantly positive, and the difference between Binance and Coinbase and Binance, between Coinbase and Binance is also positive. The Coinbase just tend to have much higher listing performance than Binance. All right, so yeah. All right, so we have some positive listing performances. So what are the rationale that we can give them? And so the fact that, so when we start with this study, so first of all, just from our own experience, we know that listing performance is positive. And also in the finance literature, there has a long tradition so-called IPO underpricing, right? So in the stock market, you also find that like when the stock gets listed, on the first day, the return tend to be very, very positive, right? So there's a very, very large literature in finance trying to understand this. And but so initially that's also what we expect. But when we think further about this, we think there's actually a lot of institutional differences between crypto listing and the stock listing. Here are a few of them. So cryptocurrency exchanges, right? For crypto listings, it's cryptocurrency exchanges, they unilaterally decide on which coin to get listed. Right? It's different from stock listing. It's usually the companies that decide on whether they want to have their shares listed publicly or not. Okay, and also for stock listings, you need either, depending on the jurisdiction you live in, you either need to get approval from regulators or you at least need to register, follow some procedures with the regulatory agencies. But this is not the case in a crypto world. So these are the one major institutional differences. And also, stock listings typically involve the creation of new shares, except for the case of direct listings. But in cryptocurrency listings, typically new units are being created, right? So it's just existing coins that are out there, but now there is a venue for investors to do secondary market trading for them. And also, third, I think is most importantly, is that for typical stock listings, it involves a deliberate choice of the offer price. Okay, in traditional stock listings, the investment banks will go on road shows and they talk to institutional investors, usually large funds, and they would ask their opinion about what they think the shares are worth, and they eventually decide on an offer price. But this is usually not the case on crypto listings. And why this point is important, because in the finance literature, oftentimes the IPO underpricing, why the first day of listing see a significant return, usually is attributed to this the offer price setting, right? Because you can say, and like why there is a high return, because the offer price is set too low. But why it's set too low? Because there's some intricate allocation, share allocation process in the roadshow and in the stock listing. So because this effect just does not exist in crypto listings, right? So we at least get rid of one major reason that the finance literature has proposed for stock listing underpricing. So that's why we think that the result is more consistent with either a certification story or a liquidity story. What is a certification story? Certification story just like, okay, well, I don't know what this coin is, but I know Coinbase, I know Binance, right? If they are willing to list this coin, then the exchange is, then probably this coin has some merit, right? The liquidity story just like, okay, now given that the coins can be traded on another big venue, so the liquidity of the coin will improve. So maybe people are more willing to purchase them. So we want to dive a little bit deeper into the certification story. So we say, okay, if the certification story holds, then we should, if we compare the coins that gets listed versus that does not get listed, and their fundamentals should show some significant differences. And this is what we are doing here. So we use different measures to measure the fundamental of a coin, and certainly this is one dimension that we focus on. Certainly there are other directions. So there's the measure that we first look at whether this is just it's a coin, so that there's an underlying blockchain associated with it, or it's just actually, for example, ERC20 token, because ERC20 token supposedly is just easier to launch, the technically more less advanced. And also the GitHub, this measure just measures whether the coin actually just has a GitHub account. So there's a very minimum requirement, and you are shocked. We're actually very shocked to see so many coins, right? So many listed coins just don't have a GitHub at all. Okay, and then just if it's conditional on whether you have a GitHub account or not, and we look at the number of commits, the number of stars, and the number of issues, that just shows up how much development activity or attention in the community that the coin can gather. And indeed, right, so this is kind of consistent with the certification story. We see that for coins that gets listed versus the coin that did not get listed, there's indeed significant differences in terms of the coin's fundamentals measured in all these ways that we're talking about. Okay, so now I'm gonna just dive into another research question we look at is potential conflict of interest. So I kind of already alluded at the beginning of the talk, and both Binance and Coinbase, they have significant venture arms, Coinbase Ventures or Binance Labs. Right? So they often invest in pre-listed early stage crypto projects. And so as I said, like, so if you run an exchange and also run a VC, then you should have incentive to prioritize listing the coins that you have invested in, right? And also this agency friction, this conflict of interest probably will show up more on an exchange in which that just faces less regulation. So we want to show whether that's actually showing up in the data. So what we do here is that just we separate the Coinbase sample and the Binance sample. So first, this table shows within the Coinbase sample, among all the coins that gets listed on Coinbase, we look at just the same measures of fundamentals of coins that Coinbase has previously invested in from their VC arms versus those that they have not invested from the VC arms. And we look at all the measures that we come up with in terms of coins fundamentals. We do not see significant differences. Okay, so there's not much evidence of agency frictions or conflict of interest showing up in a Coinbase sample. But now we look at a Binance sample. A similar exercise: previous invested coins versus previously not invested coins. And here we see, at least on two measures, we see that the previously invested coins by Binance, they show lower fundamentals than the ones that Binance has not invested before. All right. So this is some suggestive evidence that at least on Binance, which has more aggressive listing decisions, which presumably face less regulatory exposure, there's some evidence of this kind of a conflict of interest showing up. Binance is kind of listing some of the coins that they have invested. Maybe the coins they later on figure out it's probably not a good idea to invest in the first place. Now let's just list them so that we can dump to the retails. All right, so this is the first part of the case study that we have done. So now we are going to dive a little bit more into how regulation come into play. And for that, we are going to do a more full-fledged regression analysis. So we are going to have three major regression specifications. And so the way to look at this, right, these kind of pretty, the slides look pretty busy, but really what we want to show is that for each coin I listed on a coin J, on an exchange J at a particular point in time, we want to look at, for that particular listing, what is its listing performance, right? How does this listing performance is associated with the exchange characters? And also, how does the listing performance, how is that associated with how much regulatory exposure the exchange is facing? And also, we are going to look at, if we put these two forces together, what the joint effect will look like. So just here are some how do we define, like how do we measure exchange characters, and how do we measure the regulatory exposure that exchanges face? So these are the variables that we have. And actually what turns out to be the most important variable that distinguish an exchange is whether it's a top exchange, whether it's a like tier 1 exchange or not. What we found is that the about 12 exchanges in our sample basically have like more than half of the volume. So we just take whether you belong to the top 12 exchanges or not. That is a dummy variable that indicates your exchange status. And also we just for completeness, we also include whether exchange has itself issued a token or whether the exchange is a centralized exchange versus decentralized exchange. In all our regressions, we will to control for how many exchanges have already listed this coin prior to that specific listing that we're talking about. Our idea is that like if there are more listings before this exchange, then the effect of the last exchange listing probably is going to be smaller. Right? So we are expecting something negative on this coefficient here. So these are the variables that are associated with the exchange and associated with the listing. And we also look at we also come up with 4 different measures to measure how much regulatory exposure that exchange is facing. The first variable is we call listed, just whether this exchange is itself a public company. And if you run a public company, then the regulatory exposure is just going to be much heavier. And in the U.S., right, if you're a public firm, you need to report your results every quarter, right? So this adds a lot of adds a lot of burden to the management, okay, but also disciplines the management. And second is that we would just look at a variable equals to 1 if the exchange has acquired license from the local government or not. So this is like actually one of the most heavy part of our exercise, because we actually need to go to all these exchanges to see their regulatory compliance status across different jurisdictions. And the third is we just look at the regulation level of the country in which the currency or the exchange operates, and if a larger number means that there's more regulatory exposure at the country level. We also just have a dummy of 1 if the exchange is headquartered in BVI area. That was like BVI is like British Virgin Islands, but really just like all these kind of offshore like Bahamas, Seychelles, all these like kind of potentially dodgy places, and so to indicate the regulatory exposure. All right, so and then all these four dimensions will be aggregated together to come up with what we call an exchange regulation index. We do something really, really dumb, or I would say really, really simple, and just add them together. Okay, the BVI, we minus them, because if you are in BVI, then presumably you face less regulatory exposure. So we just take a linear sum or minus between these exchanges. There could be more fancy versions to do that, but noisy versions, if we still see results in noisy versions, usually is just like noisy, simple versions is actually more biased against us finding anything. All right, so just to present some of the results as so first of all, we look at how does the listing performance is associated with the exchange characteristics themselves. And what we find is that, well, whether you are top exchange or not matters a lot. If you're a top exchange, the listing performance is great. And but whether you are a centralized or decentralized exchange, or whether the exchange itself has launched tokens or not, these are not really important. Nothing really shows up very significantly over here. And if we look at the regulatory exposure, just like regulatory exposures, and we find that we do not find anything significant on the listing status, right? If the exchange, whether the exchange itself is listed or not, that doesn't seem to show up significantly. But all the other measures shows up significantly and as in the sign that we are expected. Right? If you obtain license from your local jurisdiction, or if the country that you are operating have more stringent regulatory requirements, the listing performance on those exchanges tend to be higher. If your exchange is headquartered in a BVI area, then the listing performance is slightly lower, right? And so the result on the exchange regulation index is also significant. And so now we just put all these two together, right? So we both regress both on the exchange characteristics and also interact that with these exchange regulations. So we can see that the regulation seems to kind of reinforce the result that we show from exchange characters, right? For example, like we show that, well, we have already seen that if your exchange is a top tier exchange, the listing performance will be higher. But this is all only shows up actually is all absorbed by if we were to interact with a regulation, right? If you are an exchange that is a top exchange and also you have faced very stringent regulatory requirement, then the listing performance is great. If you're kind of like operate in the dodgy places and just have dodgy practices, then it doesn't just actually show up. Okay. So yeah, so I think so basically just these are the kind of the I would say there's still very preliminary exploration into the space. What we find as summary is that we find there's significant positive listing returns on both Coinbase and Binance. The return premium on Coinbase is higher than Binance, so presumably that's kind of a indication of that maybe regulation, how much regulation you face may play a role. And there's some evidence of conflict of interest on Binance. The listing premium associated with exchange regulation, how tight exchange regulation is. And so we are like updating our data, and we want to see how all these results kind of show up in more latest data, because we know the crypto listing space has been changing a lot. So but I think at least our paper kind of provide the first look into this very topic. Yeah, thanks.
Thank you. Thank you for the talk. I have two questions. When you say listings, did you differentiate between spot or futures listings, since some exchanges just list the futures and not the spot and so on? What did you look in that case?
Yeah, for that, we only look at spot listings. We have not looked at futures listings. And so for a lot of our sample period, most of them are spot, but if we update our data, then the futures listing would be important. But for this study, we are only looking at spot, yeah, at the moment.
Okay.
Yeah. Do you expect anything we should particularly pay attention or expect from if we include futures listings, or?
I guess like back in FTX days, they were somewhat notoriously famous for listing futures first, and whenever they list the futures, that was some kind of a red alarm, like that, because whenever they did that, token seems to go down, and after some time they listed the spot. And now we have Binance doing something similar, Bybit doing also something similar. So I guess we see, as you said, you see positive returns here, but if you look at futures, I would expect to see negative returns maybe.
Okay. Yeah, that's a good suggestion. We can look into this. Yeah, for sure.
Okay, that was it.
Oh,
I forgot my second question.
okay. Yeah, I was expecting the second one. The second shoe is not dropping. Here's-
Hi. So when you say regulation, do you take does that take into account privacy of the traders? Because I feel that one reason why a lot of tokens, they shoot up after listing to Binance is that it's easier to manipulate markets on Binance because compared to, let us say, on DEXs, because there the wallets can be tracked, but on Binance, uh, only Binance knows who are the wallets who are like manipulating the market. So when you say an exchange is regulated, do those exchange like are they liable for these kind of activities, or they only have to report financial data?
So, in terms of you're talking about just very narrowly, if we're just talking about the privacy, then we show that okay, we like whether this exchange is a DEX or not, we don't see significant results. So for that particular angle, I don't think it's at play. And so just in terms of so yeah, so I think regulation probably plays at a different just plays a role in different aspects. On this particular aspect you're talking about, I don't think it's showing up.
I have a question related to this previous one. It's a curiosity. Are there centralized exchanges that use decentralized protocols? Or is it like a black and white world? Either it's centralized or decentralized?
Not within my awareness, but I certainly need to check again with the data to give a firm answer. But my impression is no. Yeah.
I see. So I think the amount of resources shared through the centralized is much larger than the decentralized, I would assume. At least.
You mean what resources?
Yeah, like tokens, money.
Maybe that's an empirical question. I don't know on top of my head. Yeah.
Okay.
Yeah.
No, thank you very much.
No.
Anyone else? Okay, thank you so much,
Thank you.
Jackson.